Hello everyone and welcome back to Finance with JCL. Here to help you on your investment journey to financial freedom. And a particular welcome to you if you're new to the channel, this is your first time watching or listening to the show. Today's topic is around the company review of NV5 Global, ticker symbol NVEE. So this review has been requested by a viewer of the channel. They are suggesting that the company seems well placed for the economic recovery in USA. So I thought that would be quite an interesting one to look at. And on that note, if you have any companies that you think would be interesting for me to review, please leave a comment and get in touch with me and I will have a look at them for you. So if you haven't come across NV5, and I hadn't before, being based in the UK, I've got a very short summary here. So they are a leading provider from their own website of compliance technology, engineering, consulting solutions, looking at the infrastructure, utility, building assets and systems area. So kind of professional and technical services. And the key kind of 6 things they look at are testing, the inspection and consulting, infrastructure support services, utility services, building and program management, and environmental health sciences with geospatial technology services. So quite a wide range of kind of quite technical areas. So the running order for today, so you know what's coming up, there'll be a review first of all of several of the fundamentals of the company and a look at their last 10 years of financials. I'll then calculate what I think the intrinsic value of the company is based on one of Warren Buffett's calculation methods. I'll then calculate, based on that, what I think the target price is, and then I'll compare that to the market price, and therefore what action I will take. Now, just to reiterate, as we've seen on previous shows, this is my interpretation of the company information. It doesn't necessarily I'm right, and you shouldn't copy me. You should take your own professional advice if you're unsure about what you want to do for your individual circumstances. So we start off with the free cash flow. Now it is positive, which is very good, and the capital expenditure requirements are very low as a proportion of the operating cash flow, which gets you to the free cash flow, and that trend is increasing. The last sort of 5 years, the free cash flow has gone from rounded to $1 million in 2014 up to 66 million in the trailing 12 months. So massive increase there. So I think in terms of my assessment model, they will get full marks for this section. It looks really positive what's happening with their cash flow. Now secondly, I'd like to look at the net income. So it has been positive since 2011. That's really good. Ideally, I'd like a company with an average of above 20% for the prior 10 years. And the average here is 4%. So it doesn't get all the marks. And in fact, the trend's okay, but I think one of the things to look at it looks like it's a growing company if you're looking at the revenue. So the net income on a growing company doesn't always keep up with that. And once they kind of get a bit larger, they can then focus on improving their efficiencies and improving their profitability. But it is a thin margin business, so trailing 12 months it's 3%, so it's not a massive margin. And if you go back to 2017, at the top year it was 7%, and it's always been kind of around that 3, 4, 5% region. So yes, it's okay, but it's not as high as I'd like it to be for a wonderful company. And then looking at the revenue, yeah, that's been growing massively. So 2010 it was $32 million US. That had grown 3 times to 2014, 108 million. And then the last 12 months, we're looking at almost 600 million. So this is really very much a growth company, which is why I wasn't too worried about the net income being a little bit lower. That might catch up later on once they've established a more dominant market position. So we know they're a growth company, and we'll now have a look at the current ratio. So what's their ability to meet their short-term obligations? And this looks really good. So the current ratio, I like to absolutely be above 1, and I desire it to be above 2. and it has been above 2 since 2013. It's sort of been even as high as 3 in 2015. But yeah, the trend's fine, it's pretty stable. So that's a really good section. So it looks like they're growing rapidly, but they are able to meet their short-term obligations. And that isn't always the case for companies growing quickly. So it's looking pretty good so far. When we look at the debt to equity, now this is where there's been a bit of a change. So I always like that to be below 2, and it very much is. The latest quarter view, it's 0.98. But if you look at the history of this, 2013 to 2018, it's generally been around 0.1. 2019, it's jumped up to 1, and it's 0.98 now. So it has increased in the last year, but it's still well below that kind of mandatory level of 2. So yeah, something to keep an eye on. And the interest coverage, as you'd expect, is also impacted. The interest coverage had improved greatly. You get to 2015, 2016, you're looking at 60 to 70. 2018, it's dropped to 18. 2019, it's dropped to 14. And the last 12 months is down to 3.58. So that interest coverage is really, really low. And I like it to be above 6 as a minimum, absolute minimum. So it's actually failed that test and the trend is worsening. So for me, at this point, I'm thinking it's failed on a mandatory test. I'm probably not going to invest in it. However, let's see what the other things come out as, because they may offset it. With the moat, I like a company to have a very strong, clear moat. And there are plenty of examples out there. So Apple has got one. Kind of one of the first. It's the first name you think of. Someone says mobile phone, you say Apple. Google's another one. You don't search something on the internet. Quite often you Google it. It's its own verb. So these are indications of strong moats. Now this organisation's been around since 1949. It's talking over 70 years. So it must be doing something right. But I need to do a bit more research into the moats. I haven't been able to identify a very clear one based on my initial review. If you guys know anything about the company, drop a comment below and help me out here. Tell me what you think about them. So we're kind of halfway through the review, so I just wanted to drop in a couple of ways how you could help support the channel if you like this information and like the kind of content that I'm producing. So one of the 3 ways would be through YouTube. So there are 3 ways on YouTube. So you could subscribe to the videos. That'd be pretty cool. You get alerted to the next one. I'm going to be doing plenty of these company reviews. Also on YouTube, you could hit the like button, and that will help flag this as good quality content that will be flagged by YouTube to other people. And also drop some comments in if you've got any information you'd like to share or any ideas. The other way is via the Patreon site. I'll drop a link in the description. You could become a supporter of the channel. And indeed, if you become a VIP patron, there's less than 20 slots available now for that. And you'll get a shout out in the videos, and it will help me continue to produce this content. So thanks for your consideration for that. So press on, we'll look at the industry. Now the industry size, I'd say it's medium sized, and it's certainly one that will be here for over 10 years. So I think that's very positive. And I think it is a growing industry, these kind of technical services, professional services. So yeah, generally pretty good in this area. I'll want to look at the return on equity. So that's one of my favourite numbers. Now this hasn't been so good, so I like this to be above 8%. And in the trailing 12 months, it's actually been 5%, and that's the lowest it's been since 2010. So this is pretty bad. And the 10-year average is 11%. I like it to be over 20%. And the trend is worsening, so it gets no points of return on equity. So again, it's failed by mandatory tests. So I'm thinking about stepping back from a value investing perspective in this company. And then the dividend. So the earnings per share is okay. They're not paying a dividend. And that's fine, because as a growth company that we looked at from the revenue, they shouldn't be paying a dividend if they need that capital to grow the company. So they weren't going to be marked to it, but that, I don't take that as a negative because they're a growth company. And then I look at the price to earnings ratio, that's 44. Now, I don't like to invest in companies generally with a price to earnings ratio that high. So the indication is, in all probability, when I run the numbers on the intrinsic value and compare that to the price, it's probably going to be too expensive. But in 44, you do get growth companies with very, very high P ratio sometimes. You just need to be very careful. So it's not necessarily something to make a decision based purely on it, but it's an indicator. And the indicator is they need to up their earnings to justify their current price. Similar to price to book, I mean, that's 2.23. So again, it's not something I necessarily use to make a decision by itself. But if it's lower than 1, and quite a bit lower than 1, sometimes that can represent quite a lot of value. And there are some financial firms out there at the moment where that price to book is lower than 1. So there's potentially some value there. Now, all of this information has come from the Morningstar website. So that concludes the sort of high-level review of the numbers and that 10-year trend review. So it's now time to look at the cash flow analysis to calculate the intrinsic value. I'm using a discount rate of 10% because I either want to get a 10% return if I'm going to invest in this business and own part of them. And that's very much how I think. I'm not owning a stock or buying a lottery ticket, I'm actually owning part of a business. So there's an 8% growth rate, and that is my calculation, what I think they're going to do in the next 10 years, 8% a year. So that leads me to calculate an intrinsic value of $95.46. So what I do then is I look at the market price, and the market price is $62.84. So therefore there's a margin of safety of 34%. A reasonable margin of safety. The reason is, if, let's say the price was 100 and you knock off 34%, you're down at 66. So to get back to the original 100, you actually have to grow 50%. So if you're buying it a third down, the upside to get to intrinsic value is 50%. So buying it at this point would be a 50% upside. However, I like to buy with a 50% margin of safety, especially in a business like this where the margins are very thin. And actually I wouldn't buy it anyway because it fails to the mandatory test, but hypothetically if I was, I'd want a 50% margin of safety. So is it better than some of my existing portfolio? Absolutely not. I have better organisation to my portfolio. So therefore, if I had capital available, I wouldn't buy this company. I would buy more of the better organisation. I'm not buying it, and therefore I won't add it to my wish list or set up an alert. There is some mileage in the notion they will benefit from the recovery that will happen in America as the virus dies down and the economy and infrastructure starts being invested in. And I think their services, could well be in demand, they could well grow, but based purely on metrics and calculations, so very much a conservative value investing approach, this isn't a company for me. If you've got any different information that I haven't considered, please drop it in the comments, please get in touch so we can get a wider picture of this organisation. And of course for me it's not a buy, but you may have different criteria and you may have different ways of assessment. So if you've got a different idea about what you think the intrinsic value is or whether you're going to buy it, let me know, get in touch, I'll be really interested to hear about it. So that concludes it for today. So thanks very much for joining me and spending some of your time going through this with me, and I look forward to seeing you next time.